Imagine two friends take the same loan for the same amount, same bank, same purpose, same day. 5 years later, one of them has quietly paid thousands less in interest and has more room in their budget for travel, investing, or just breathing. The other one? Still stuck with easy payments that turned out to be anything but cheap. The difference wasn't luck. It was one simple thing: how they matched their loan term and interest rate. Today on Fedah Signals, we're unpacking term versus rate, the cheaper loan secret the wealthy use, so you can borrow smarter, not just cheaper per month. Welcome to Fedah Signals. I'm Fedah. I break down the big money mechanics and connect them to your actual life, your mortgage or rent, your car payments, your debt, your long-term plans. This video is education, not personal financial advice. Always check with a licensed professional before making big money moves. But if you've ever wondered, should I focus on the rate or the term? This one is for you. The three moving parts in any loan. Let's start simple. Whenever you borrow money, there are three numbers quietly negotiating with each other. Principal, the amount you borrow. Interest rate, the percentage price you pay each year to use that money. Term, how long you take to pay it back. If you fix the amount you're borrowing and you change either the term or the rate, the other pieces will move. Most people focus on one question: what's the monthly payment? Can I handle it? Lenders know this. That's why so many offers are framed as only this much per month, or spread over more years for easier payments. But here's what the research and calculators agree on. Longer term, lower monthly payment, higher total interest paid over the life of the loan. Shorter term, higher monthly payment, lower total interest, and often a better interest rate because the lender's risk window is shorter. So when we say term versus rate, we're really talking about, do I want cheaper today or cheaper overall? Wealthy borrowers don't ignore the monthly payment, they just refuse to stop there. Two paths, same loan, very different futures. Let's walk through a simplified example. You don't need to memorize numbers, just catch the pattern. Same loan amount. Two options. Option A, shorter term, lower rate. Option B, longer term, slightly higher rate. What usually happens? The shorter term, the payments each month feel heavier, but the total interest over the life of the loan is much lower. The longer term, the payment feels comfortable, but you carry the debt for many extra years and interest keeps stacking up. Now imagine this not just with a mortgage, but a car loan, a personal loan, consolidated credit card debt. One decision you might make is, I want the lowest monthly payment, full stop. That's understandable, especially if cash is tight. But here's the wealthy mindset. I want the lowest lifetime cost that still lets me live my life and sleep at night. They look at how much interest they'll pay in total, how the term fits with the life of the thing they're buying, shorter term for assets that don't last forever, more caution with long-term debt for short-term wants, how those payments affect their ability to save, invest, and stay flexible. Same loan size, same bank. Different questions, different outcome. How the wealthy actually use term versus rate. So what are wealthy borrowers doing differently with this term versus rate idea? Let's break it down into real behaviors, not myths. 1. They negotiate with total cost, not just monthly cost. When they see a loan offer, they don't stop at, okay, the payment fits my budget. They ask, what's the APR? Over the full term, roughly how much interest will I pay in total? If a shorter term or a slightly better rate cuts years of interest, they pay attention. 2. They understand the usual pattern, shorter term, better rate. Lenders often offer lower interest rates for shorter loan terms because the risk window is shorter and they get their money back faster. So a wealthy borrower might say, if I can afford the payment on a shorter term, that's often cheaper overall. Or, If I need a longer term for flexibility, I'll still overpay whenever I can to kill off the interest faster. In other words, they might choose a longer term on paper for safety, but behave like it's a shorter term when they can pay more. 3. They shop for rates like it's a high-stakes purchase. Most people accept the first rate a familiar bank offers. Research shows that shopping around for multiple quotes can significantly reduce borrowers' rates and total cost, especially in high-rate environments. Infotainment. Wealthy borrowers compare offers from several lenders, pay attention to fees, not just the headline rate. Look at how rates change with different terms. They know that shaving a little off the rate, combined with a thoughtful term, can quietly protect a lot of future cash flow. 4. They match debt to their bigger plan. High net worth mortgage advice often emphasizes this. Shorter terms mean faster equity and less total interest, but you have to balance that with liquidity, having enough cash for emergencies or opportunities. Wealthy borrowers ask, if I commit to this heavier payment, do I still have margin in my budget? If I go for the longer term, do I have a plan to overpay or refinance when my situation improves? The secret isn't a trick. It's that they purposely connect each loan to their lifestyle and long-term goals, instead of taking whatever looks easiest right now. Turning this into a practical checklist for you. Let's turn this from theory into something you can actually use. The next time you're about to take a loan or refinance, use this 5-question checklist. You don't need to be rich to think like this. Question 1. What's the total cost, not just the payment? Ask the lender, if I keep this loan for the full term, about how much interest will I pay in total? Then ask, what if I choose a shorter term? What's the total interest look like then? You're training your brain to see lifetime cost, not just monthly comfort. Question 2, is there a shorter term with a better rate? Ask, if I choose a shorter term, does the interest rate drop? If yes, you might be getting a double benefit, higher monthly payment, but a lower rate and fewer years of interest. If the payment still fits safely within your budget, that might be your wealth-minded option. Question 3, what flexibility do I have to pay more later? Sometimes taking the longer term is actually a wise move if the lender allows extra payments without penalty, you have uneven income, or you want the safety of lower required payments. Ask, can I make extra payments toward principal? Can I increase payments later without refinancing? Then, even with a longer term, you can behave like a shorter-term borrower when life gives you a bit more room. Question 4. Does this loan term match the life of what I'm buying? General rule wealthy people respect. Longish term for a house or long-lasting asset. Much more caution using multi-year debt for short-term wants. It's hard to feel like you're living a rich life when you're still paying interest on something you've already thrown away or upgraded years ago. Question 5. What does this loan do to my future options? Ask yourself, if I take this term and this rate, how will it affect my ability to save or invest, my stress level, my ability to handle a surprise expense? The wealthy mindset is not debt is always bad or debt is always good. It's, does this specific loan with this term and this rate support or suffocate the future I'm trying to build? Let's bring it home. When you hear the cheaper loan secret the wealthy use, it's easy to imagine some hidden product or complex strategy. Most of the time, it's not that. It's the habit of zooming out. Not just asking, can I handle this payment right now? But also asking, what is this really costing me over time? Is there a smarter way to combine term and rate? Does this loan support the kind of life I want to build 5, 10, 15 years from now? Wealthy borrowers don't always choose the shortest term. They don't always choose the lowest rate. They choose the combination that protects their future options, their peace of mind, and their ability to grow. If you start looking at your loans this way, even for small ones, you're already thinking like them. If this helped you see loans in a different light, tap like so more people can find it, and subscribe to Fedah Signals. Here we connect the big forces in the economy to the choices that quietly shape your everyday life. See you in the next one.